Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, June 10th, 2026. We're Elena and Marcus.
And we have a highly complex tape to review for you today.
We really do. Our daily desk data is signaling, well, a definitive shift in the market regime.
Right. We are moving away from the pure growth narratives we've seen over the last 2 years.
Entering a phase where, the cost of capital is beginning to ruthlessly discriminate between companies that generate free cash flow
and those that rely on continuous external funding.
Correct. So let us establish the framework right away so you know exactly how today's pieces fit together.
We are tracking 4 critical themes from today's data deck, and this is a single interconnected chain of events.
First, we have the stagflationary macro setup. We need to explore how escalating military tensions in Iran are completely overriding what was actually a softer-than-expected core CPI print here in the U.S.
Second, that macro pressure leads directly into the tech and semiconductor unwind. We tracked a violent de-risking in equities today,
highlighted by a massive collapse in supermicrocomputer and a critical technical breakdown in NVIDIA.
Third, we have the gold discrepancy. Why gold is plunging despite that rising geopolitical risk, even as WTI crude pushes toward $90 a barrel.
And fourth, the credit divergence. The widening spread between CCC and Baa junk debt is telling us exactly what the broader economic regime looks like beneath the surface.
Understood.
Moving to today's data, let's begin with the macro driver dictating all cross-asset moves today. From our latest run, the May U.S. CPI headline hit 4.2% year over year.
Which is a 3-year high.
Right. However, core CPI came in lighter than expected at 0.2% month over month.
It did, yeah.
Now, my initial thought when looking at this morning's data was that a cooling core CPI gives the Federal Reserve the exact ammunition it needs to begin cutting rates.
You'd think so, but the global rates reaction was uniformly hawkish.
Exactly. The 10-year yield climbed 3.4 basis points to 4.554%, and the 2-year yield sits at 4.147%.
With the 30-year remaining stubbornly above 5%.
So looking at the divergence, there is a glaring contradiction here. If core CPI was actually cooler than expected, why did the 10-year yield climb today?
Well, it comes down to first principles. The yield on a 10-year Treasury is essentially made up of 2 parts.
Okay.
First, you have the expected path of short-term interest rates set by the Fed. Second, you have the term premium.
Let's break that down for the listener. Term premium is the extra compensation investors demand for the risk of locking up their capital for a decade.
Correct. And embedded within that overall yield, you also have real yields, which is the actual return you receive after stripping out expected inflation.
Got it.
So today, our desk data shows that markets are aggressively pricing in a geopolitical oil shock.
And that energy shock entirely overrides the soft core domestic data.
Indeed. Because institutional investors realize that higher oil prices will inevitably bleed into broader inflation down the line.
It acts as a tax on the consumer and raises input costs for manufacturers.
Correct. When energy prices surge, it filters into transportation, logistics, and manufacturing. It pushes future inflation expectations higher.
So the bond market is looking past today's backward-looking core CPI print.
Right. And pricing in the forward-looking reality of $90 oil. The Federal Reserve is effectively trapped. They cannot cut rates into an energy-driven inflation spike.
Consequently, investors are demanding far more compensation for inflation volatility, which pushes the term premium higher.
On that point, our proprietary positioning updates confirm this shift. The market is now fully priced for only a single Fed hike by December 2026.
With 0 cuts on the table.
Exactly. For you, the listener, the mechanical takeaway is that the cost of capital, meaning mortgage rates, corporate borrowing costs, and auto loans, will remain elevated.
The geopolitical energy shock is effectively tying the Fed's hands.
And we are seeing similar pressure internationally, proving this is a globally coordinated regime shift. Bank of Japan Governor Ueda is hospitalized.
Which injects severe governance uncertainty right before their policy meeting.
Right. It raises intervention risks significantly as the U.S. dollar to yen pair holds near 160.55.
Meanwhile, the Bank of Canada held rates at 2.25% today.
And in their release, they specifically cited the dilemma of weak growth paired with oil-driven inflation. They are facing the exact same trap as the U.S. Federal Reserve.
Understood. That macro pressure does not exist in a vacuum, though. The sustained high cost of capital is triggering a severe re-rating in high valuation sectors.
Which leads us directly into today's equity flows.
The broader indices took a significant hit. The S&P 500 closed down 1.62% to 7,266.99.
establishing a 5-week low.
The Nasdaq 100 was down nearly 2%. But the real pain was in the semiconductor index, the SOX, which cratered 3.57%.
And looking at international tech flows from our overnight desks, the Kospi also took a massive hit today.
Largely driven by semiconductor weakness bleeding over from the U.S. session.
Correct. The specific movers within that space highlight a violent repricing of capital needs versus fundamental growth. Supermicrocomputer collapsed 28% today.
The catalyst there was their announcement of a $7 billion equity raise. But I want to pause on Supermicrocomputer because there is a mechanical tension there.
Yeah.
They explicitly signaled $39 billion in orders on their books. Normally, a massive order book is a violently bullish signal.
Right.
So why does an order book of that magnitude get completely overshadowed by an equity raise?
Because it proves that funding the AI server build-out is becoming prohibitively expensive in a high-rate environment.
Oh, I see.
Building out multi-gigawatt data centers and securing the thermal management hardware requires massive upfront capital expenditure.
And when a company issues $7 billion in new equity, they are expanding the pool of total shares.
Indeed. That dilutes the ownership stake of every existing shareholder. The market interpreted this capital raise not as a sign of strength, but as an admission that their internal cash flow is insufficient to fund their growth.
Right. In a world where the 10-year yield is marching toward 4.6%, the market will severely punish any company that requires external financing to survive.
And that structural repricing dragged down the entire sector. NVIDIA dropped 3.2% today, structurally breaking below its 50-day moving average.
A level it has held firmly since April.
Right. Post-close, Oracle fell 8% on a cloud revenue miss, and Taiwan Semiconductor dropped despite posting 30% revenue growth.
Our desk data attributes the TSMC selling to mounting fears of strict AI chip export controls to China, further complicating the growth narrative.
We also tracked notable fundamental selling across Broadcom, AMD, and Qualcomm.
This is where our proprietary options desk data becomes crucial for understanding the sheer velocity of this sell-off.
Correct. The market is currently trapped in what we define as a negative gamma regime.
Today, the spot price structurally broke below the primary put wall at 7,350.
Furthermore, systematic CTA supply thresholds are being breached. These are the mechanical triggers that force algorithmic trend-following funds to begin selling.
To make that negative gamma regime concept tangible for you, we need to look at the mechanics of the options market. Do not think of it as just a snowball rolling down a hill. Think of it like an insurance market in crisis. When you buy a put option to protect your portfolio, an options dealer, a market maker, takes the other side of that trade.
They're essentially writing you an insurance policy.
But those dealers want to remain delta neutral. They do not want to take a directional bet on the market.
Indeed. To hedge their exposure as the market drops, they must short the underlying futures.
So when spot prices fall below major options support levels, like that 7,350 put wall, those market makers find themselves holding the wrong exposure.
It is like an insurance company that realizes they wrote too many fire policies for a neighborhood that is currently engulfed in flames.
To hedge their own escalating risk, they are forced to run out and buy fire extinguishers at any price.
Right. In the market, that means they aggressively short futures to balance their books. Selling forces the market lower, which forces dealers to short even more futures,
creating a reflexive downward spiral. Escalator up, elevator down.
Correct. In a normal, positive gamma regime, dealers buy the dips and sell the rips, which acts as a shock absorber and suppresses volatility.
But right now, we are operating in the void beneath that broken floor.
The localized long gamma nodes on the upside are completely dwarfed by downside put structures.
Downward momentum remains the path of least resistance until price discovery finds a footing,
which our positioning updates suggest is likely around the next major liquidity node at 7,200.
Moving to today's data, that algorithmic selling in tech is being directly triggered by the very thing pushing those yields up in the first place, the energy complex.
Right. WTI crude settled near $90 a barrel today, while Brent crude hit 95.
This is being driven by U.S. Central Command strikes on multiple targets in Iran.
And this geopolitical shock is arriving at the worst possible time for supply chains, compounding a 9th consecutive week of U.S. crude inventory drawdowns.
That inventory drawdown cannot be overstated.
It really can't. We are seeing the U.S. domestic supply buffer shrink precisely at the moment Middle East transit flows are facing acute disruption.
The market is being forced to price a persistent, structural geopolitical risk premium into every single barrel of oil.
It is no longer just a speculative trade, it is a fundamental physical shortage risk.
But this brings us to the glaring discrepancy in our hard asset data that I mentioned at the start of the briefing.
Right, the gold move.
My initial assumption, based on decades of market history, is that during a major geopolitical military escalation in the Middle East, actual military strikes involving U.S. forces, gold, should rally aggressively as the ultimate safe haven.
That would be the traditional logic.
Yet today, gold suffered its largest single-day drop in months, falling a massive 4.43% to roughly $4,072 an ounce. If we are seeing a major military escalation, why did gold just crash?
On that point, it seems highly counterintuitive, but it perfectly illustrates the dominance of interest rates over pure geopolitical fear.
Okay.
What you are witnessing is the aggressive unwinding of the debasement trade.
Right. Over the last few years, the dominant narrative driving gold was the assumption that central banks would be forced to continuously debase fiat currency to fund massive government deficits.
Investors bought gold as a hedge against the destruction of the dollar's purchasing power.
But rising real yields are the natural enemy of gold.
Correct. With the 10-year TIPS yield, which is the Treasury inflation-protected security, pushing up to 2.2%, the math fundamentally changes.
An investor can now get a guaranteed inflation-adjusted return of 2.2% on a risk-free U.S. government bond.
Exactly. And gold, by its nature, yields absolutely nothing. It pays no dividend and no interest.
So when the real cost of holding a non-yielding asset spikes, institutional capital rotates out of gold and into government bonds.
The severity of today's drop proves the market is currently far more focused on Federal Reserve hike repricing than it is on pure geopolitical fear.
Understood. We need to bring all three of these asset classes, rates, equities, and commodities together to define the overarching market regime for you.
And our credit desk data offers the final piece of the puzzle. It shows a severe fracture in the corporate bond market.
Global investors now require 6.4 percentage points of extra yield to own CCC-rated bonds over Baa debt.
That is a five-fold difference and the highest multiple we have seen in more than a decade.
Yet, despite that extreme stress in the lowest quality tiers, broad high-yield ETFs like HYG and JNK only declined about 20 basis points today.
They are diverging sharply from the 1.6% drop we saw in equities.
So what does this divergence actually tell us about the broader economy?
It tells us we are officially entering a stagflationary soft landing environment.
Let us unpack the mechanics of a stagflationary soft landing, because typically those terms seem contradictory. Stagflation implies stagnant growth and high inflation,
Right.
while a soft landing implies avoiding a recession entirely.
The synthesis of the two means that economic growth is slowing just enough to pressure the high valuation tech equities.
And inflation is running hot enough to keep interest rates elevated.
Indeed. But the broad economy is not experiencing a systemic collapse. Equities are selling off largely due to overextended valuations, massive positioning overhangs in the semiconductor space, and that negative gamma dynamic we discussed.
But the broader credit markets are holding firm because widespread corporate defaults are not spiking yet.
The defaults are entirely isolated in the lowest quality tier.
We are looking at companies that binged on cheap debt during the 2021 leveraged buyout boom. They took out floating rate loans when rates were near zero.
Right.
Now they're facing a maturity wall in 2026, and they simply cannot afford to refinance their debt in a market where borrowing costs have quadrupled.
Correct. The pain is highly concentrated in that heavily levered CCC tier. For the broader high-yield market, there is actually a structural buffer in place.
High-yield indices have a heavy weighting of energy companies.
And those companies generate immense free cash flow when oil's at $90 a barrel. So the energy sector's strength is masking the weakness in other highly levered sectors.
For your portfolio strategy, the rotation out of tech and into energy and defensives is the clearest possible expression of this stagflationary regime.
Before we wrap up today's briefing, we want to leave you with a final internal debate from our proprietary desk notes.
It is a structural demand question you need to consider as you review your tech exposure. We are seeing a divergence in the AI narrative.
Right now, the market is aggressively funding massive, centralized cloud infrastructure, building massive server farms that consume gigawatts of power.
But what if the utility of AI decentralizes faster than that infrastructure can be built?
If AI becomes hyper-democratized through smaller, open-source models that can run locally on the hardware you already own, like your laptop or your smartphone, Are we vastly overestimating the future need for massive centralized cloud computing and edge infrastructure?
If everyday reasoning tasks shift to local devices, the structural demand for thousands of new data centers might be an illusion.
It is the structural demand question that challenges the very foundation of the capital expenditure cycle we have been tracking.
If the demand shifts from centralized cloud computing to localized processing, the premium placed on these mega-cap hardware providers could compress violently.
Completely reshaping the semiconductor hierarchy. To quickly recap today's core takeaways, sticky inflation and geopolitical energy shocks are driving the real cost of capital higher.
This sustained pressure is violently re-rating tech valuations, exposing deep structural fragilities in options market positioning.
And simultaneously driving a massive wedge between low-quality and high-quality corporate credit.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color. The World Cup starts tomorrow, so make sure to get your brackets filled out.